In this video, we're going to take a deep dive into direct indexing to see if it's something we should consider as part of our portfolio. Hey everybody, welcome back to the Financial Freedom Show. My name is Rob Berger. For those that are new to the channel, it's all about financial freedom here. I focus on investing and retirement. This is not a get-rich-quick channel. This is a do smart things with your money, achieve financial freedom, and have a great life kind of channel. So if that's of interest to you, please subscribe. Also, I do send out a weekly newsletter every Sunday morning. It's free, and you can sign up for it with the link below the video. Today's video is going to cover 6 things. First, we're going to take a look at what direct indexing is and how it works. Second, we're going to look at its potential benefits. Third, we'll look at its drawbacks. Fourth, we're going to focus on tax loss harvesting, which is a feature of direct indexing that's most often promoted by those who offer the service. Fifth, we're going to look at who specifically might actually benefit from direct indexing. And then finally, we're going to talk about a few of the brokers that offer it and how much it costs. So what is direct indexing? Well, keep in mind that we can own an index, such as the S&P 500, through a mutual fund or ETF. With direct indexing, however, we actually invest in some number of the companies that make up the index. So for example, we might be able to get the risk and returns of the S&P 500 by purchasing just say 100 of the companies that are in the S&P 500. If we wanted to model the total US stock index via direct indexing, perhaps we might purchase 500 or 600 of those companies. What we know is we can get pretty close to the risk and returns of an index by investing in a relatively small number of the companies that make up the index. And of course, over time though, we're going to have to rebalance buying and selling those companies in order to continue to track the index that we're targeting. All of this raises a really important question. Why go to all the trouble? I mean, after all, Jack Bogle made it really easy and inexpensive to invest in an index. Why are we complicating it? Well, proponents of direct indexing offer, I think, 3 primary potential benefits. The first is what's called ESG investing. That stands for environmental, social, and governance. The idea behind ESG investing is that you can invest in companies that you believe are being responsible with how they treat the environment, how they treat their customers and employees, for example. Now, there are plenty of ETFs and mutual funds that focus on ESG investing. So for me, I really don't think direct indexing is necessary to achieve that outcome. But what it would allow you to do is decide for yourself. Maybe it's really important to you. You haven't found an ETF or mutual fund that matches exactly your own personal beliefs. And so with direct indexing, you could customize the index by excluding the companies that you don't believe in and including those companies that you do. So that is, in theory, one potential reason to follow direct indexing. Beyond ESG investing, some refer to personalized indexing. The idea is you do pick and choose the companies that end up in your direct indexing portfolio. It might not be for ESG investing reasons, but there could be other reasons. Maybe you just believe that some companies, say in the S&P 500 index, will do better than others, and you want to include those in your portfolio and exclude the ones you don't think will do as well. In that sense, direct indexing really becomes nothing more than active management. Now, there is one other concept here, and that is if you work at a very large company in the S&P 500, say Microsoft or Apple, for example, and you have substantial stock options with that company, some have argued you can use direct indexing to exclude that company from your portfolio so that you don't have even more exposure to it. I suppose there might be some merit to that. It's not going to apply to the vast majority of people, and personally I'm not sure the additional exposure would be that big of a deal, but if that's important to you, direct indexing might be the answer. The third reason to consider direct indexing, and by far the one that's the most talked about, is tax loss harvesting. Recall that tax loss harvesting involves selling an investment at a loss, locking in that loss that you can use for taxes, and then buying a similar but different type of investment to replace it. Remember, with tax loss harvesting, we always have to be mindful of the wash sale rule. We can't simply turn around and buy back the very investment that we sold. Now, if you're investing in an S&P 500 index fund, the entire fund has to be at a loss for you to take advantage of tax loss harvesting. With direct indexing, you can actually have a portfolio that on the whole is actually up, but there could still be individual securities in your portfolio that are at a loss. And with direct indexing, you can sell those securities, replace them with similar but different companies in the S&P 500, and enjoy the benefits of tax loss harvesting. As an example, in a Vanguard study, they pointed out that in the fourth quarter of 2021, the S&P 500 index as a whole was up 9.76%. Yet at the very same time, 133 companies in the S&P 500 actually showed a loss that quarter. So that's the idea. In direct indexing, you could sell some or all of those companies if they were in your portfolio, lock in the loss, reinvest into a similar but different company in the S&P 500, and enjoy the benefits of tax loss harvesting. In contrast, if you own just the ETF or mutual fund index, you wouldn't have had any tax loss harvesting opportunities that quarter because, again, as a whole, the S&P 500 was up almost 10%. Now, I will admit, at least initially, there's a lot of appeal to the tax loss harvesting benefits of direct indexing. But before we get too excited, we have to dive into the details to understand just how much benefit tax loss harvesting really is when it comes to direct indexing. Before we get there, though, there are some downsides to direct indexing that we need to consider. The first are the fees. Direct indexing is not free. There are several services now, we'll talk about a few of them in a minute, but they tend to charge between 25 and 40 basis points a year. And while that may not seem like a lot, that adds up over time, as we know. To show you just how much 40 basis points in fees can eat into our wealth, I'm going to use this free compound interest calculator from investor.gov. Now, I'm assuming a $1 million lump sum investment. Obviously, you can put in a different number, but the magnitude of the effect will be the same. I'm going to assume no monthly contribution and that we invest this money for 25 years. And as a starting point, I'm going to assume 9% interest or return compounded daily. And you can see down here the number, it's about we'll call it $9.5 million. Now, let's just reduce this by 40 basis points. That almost 5 drops almost $1 million, 8.5. So the fees for direct indexing, while they may seem small, can have a significant impact on our wealth over time. The second problem with direct indexing is it's complicated. This is not the kind of thing that we can do on our own. That kind of gets us back to the fee issue. We have to pay someone to do this for us. I suppose you could do this on your own, but I got to tell you, I'm not interested in trying to manage a portfolio of 100 or more stocks and then having to rebalance it every quarter. The third issue is what's called tracking error. Yes, it's true that, say, with the S&P 500, you can mirror the risk and returns pretty closely with just 100 or so stocks, but it's not going to be perfect, and the tracking error can grow as tax loss harvesting kicks in. As some stocks are at a loss and get sold, and similar but different companies are used to replace them, the tracking error can grow, and it's not something that we should dismiss lightly. One study showed that the tracking error for excluding weapons, tobacco, and gambling companies, for example, was, I believe, relatively modest, as you can see, around 20 to 30 basis points, but still something to keep in mind before making an investing decision. Excluding fossil fuel companies from the direct indexing approach, however, creates much more significant tracking error. For example, from 2016 to 2021, according to this study, the tracking error exceeded 1%. And once you factor in tax loss harvesting, the tracking error can grow. And that brings us to the next issue, and that is tax loss harvesting. How beneficial is it really? According to one study from Fidelity, the benefits of tax loss harvesting are quite substantial. As you can see from this chart, they show that an investment in 2002 over the next roughly 20 years had a tax loss harvesting value of over $500,000. As with most studies, however, the devil's in the details, and by details I mean the assumptions that they use to reach these results. For example, the study assumes that the investor invested a lump sum $1 million into the direct indexing portfolio. Fidelity also assumed that for all the tax losses that were harvested, they could be used immediately to reduce any realized gains. That may be an assumption that's valid for some folks, but not for most. Finally, Fidelity completely ignored the future taxes that you would have to pay once you eventually sold the investments in your direct indexing portfolio. In short, the assumptions that Fidelity made one thing certain. This study applies to almost nobody. So I went in search of a study that might be, I don't know, a little more balanced, that would give us an idea of what the advantages really are of direct indexing when it comes to taxes, and I found one. Here's the study I found in the Journal of Beta Investment Strategies. It's called The Tax Benefits of Direct Indexing, Not a One-Size-Fits-All Formula. Now I'll leave a link to this study below the video. Here was the big takeaway for me, is that the advantages of tax loss harvesting, at least for most people, decay over time. You may have some tax losses to begin with, say if you invest a lump sum into a direct indexing portfolio, but let's remember what happens as we're harvesting these tax losses. Let's imagine we've bought Coca-Cola at $100 and it's gone down to 80. We sell it, we get that $20 tax loss, and we buy, let's say, Pepsi. Well, now our cost basis is lower. It was 100, now it's down to 80. And it might go lower further, particularly if we're in a bear market. But over time, what's going to happen? Well, the securities in our direct indexing portfolio are going to go up. And eventually, they have so many gains in them that the odds of a tax loss diminish. What this study found was that by about year 5, there's almost no benefit to tax loss harvesting if you invest a lump sum in a direct index portfolio. And that's a real problem, because here's what's going to happen. You will have gotten some tax losses to begin with. That could be a benefit, but eventually, as we've noted, the tax loss benefit is going to diminish to basically zero. And then what are you left with? You're left with a portfolio that's got 100 or more individual stocks in it. You're paying a fee to have this, and there's no easy way to get out of it. You could certainly take over the portfolio on your own, have the securities transferred in kind to a different broker or a different account, for example, but then you're left managing a portfolio of 100 or perhaps more individual stocks. You could sell the portfolio to go back to a Jack Bogle, easy, low-cost ETF, but of course you're going to incur all of the capital gains, basically wiping out the benefit of tax loss harvesting in the first place. And it's for this reason that I think direct indexing is not a good approach for the vast majority of people. There are, however, a couple of situations where direct indexing and the tax loss harvesting benefits of it might make sense. One example is a high net worth individual in the top tax brackets and who has investments outside of the direct indexing portfolio that throw off a lot of capital gains every year, particularly short-term capital gains. So who might that be? Well, someone who invests in derivatives or perhaps hedge funds. Again, I know this doesn't apply to the vast majority of people, certainly doesn't apply to me. But if you're generating those short-term capital gains every year, then the tax loss harvesting benefit could be substantial, particularly if you continue to contribute each year to the direct indexing portfolio, extending that 5-year decay that we talked about. In fact, in one Vanguard study, they basically laid this out. You can see it here. They say it really is best for high net worth clients who have large, regularly arising capital gains. And here they're saying, look for realized capital gains on the order of at least 3 to 4% of taxable equity holdings per year. Now, in my case, our investments are very, very tax efficient. In most years, we don't have any capital gains, let alone 3 to 4%, and certainly no short-term capital gains. But if you fit into this category with hedge fund investments and high net worth, top tax brackets, direct indexing and its tax loss harvesting benefits might be for you. The second type of investor who might benefit from direct indexing and its tax advantages are those who plan to donate the direct indexing portfolio to charity. The idea is that you can get the benefits of tax loss harvesting for several years in the direct indexing portfolio. At that point, there's substantial gains in this portfolio. You certainly would want to try to avoid selling it and having to recapture all of those gains. But if your plan was to donate it to charity, you could donate those stocks either to a donor-advised fund or directly to a charity in kind. You wouldn't have to recognize the capital gains, and you'd have another potential tax deduction. Beyond those two investor profiles, however, I don't think the tax benefits of direct indexing are all that favorable. In fact, you end up with an expensive, complex investment portfolio with tax loss harvesting benefits that decay in just a couple of years. All of that said, if direct indexing is something you want to consider, there are several services and brokers that offer it. One of the first is a robo-advisor called Wealthfront. They offer direct indexing. and it's part of their regular plan. It costs 25 basis points. It's the least expensive direct indexing portfolio that I'm aware of. Two others that have started recently offering direct indexing to retail investors are Schwab and Fidelity. They both have offers that cost 40 basis points. So there you go. I hope you found this helpful. If you have any questions about direct indexing, please leave a comment below the video. I'll be happy to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.